just going to try and find his presentation while he gets ready to speak. Here we go.
Right, is that okay? Good. I wanted to, I've been asked to look at the history of these ideas and to contextualize the wider discussion. And my theme really is on the possibility of making money in commons. And of course that will touch on the issue of economic democracy. To set the scene, it seems it's useful to see the present 30-year period as being rather exceptional. John Gray, in his book False Dawn, critiqued the neoliberal experiment after being a cheerleader under the early years of Mrs. Thatcher as an intellectual for free markets. And he concluded in 1998 that actually the experimentation of free markets is exceptional historically. And really one of the few periods in history where you see it was between 1830 and 1870, which was a period where Britain experimented with the free market to utter disaster. It was a period of the workhouse. It was actually a period of democracy, lack of democracy. In fact, it wasn't until the 1870s, where the suffrage was extended to working class people, that you begin to see this struggle for socialization of the market. Hyman Minsky is famous for predicting this disaster. His book, Stabilizing an Unstable Economy, and his financial instability thesis, written in the mid-80s and 1992, predicted that if you deregulate markets, then of course you get this instability problem, which actually relates to the lack of control of the cost of capital. And he divided borrowers into three types in a free market without controls. Because those are hedge borrowers who can pay capital and interest, speculative borrowers who can only pay interest, and Ponzi borrowers who can pay nothing. And it was really the last group, the so-called, in America, the subprime crisis, no income, no jobs, no assets, were lent money on the strength of a property bubble. And of course, when that was punctured, of course, the whole domino effect, as we know, the whole pyramid of unsustainable credit has collapsed. The difference between now and the Great Recession is that when Roosevelt came to power in 1933, he basically had to wipe out and liquidate 40% of the banks because the toxic debts were too high. The issue for us, it seems to me, is that if you look historically at social controls, most markets have had some kind of social control. In other words, the usury laws in Britain, just to take an example from 1235, Henry VIII, of course, legalizes interest at 10%. During the English Civil War, that was reduced by Cromwell to 6%. And then in The Wealth of Nations, Adam Smith argued that actually the maximum interest should only be 5% cap. And there was a debate between Adam Smith and Jeremy Bentham in 1787, where Jeremy Bentham wrote this tract called The Defense of Usury. And he argued that interest should actually not have a cap. It should actually reach the particular level in the market that actually demand and supply will decide. Smith refused to accept Jeremy Bentham's argument, feeling very strongly that small businesses, farmers, and basically enterprise would be actually badly impacted if there was basically no cap on the level of interest. Jeremy Bentham went out. So by 1854, usury ceilings in the United Kingdom were abandoned. They were reintroduced to control pawnbrokers and moneylenders. And so in 1927, there was a cap at 48%. But in 1974, just as the neoliberal economy was gearing up to take off, the Consumer Credit Act in the United Kingdom abolished any ceiling on interest. The United States, many states had caps on interest, but in the 80s the same thing happened. The abolition, not every state, but most states, of any control, any social control on interest. So now we have usury is pervasive. I've worked in the 80s setting up debt counseling centers in the United Kingdom and national debt line, business debt line, a whole range of insolvency services. And what I noticed as a young man going to court and representing people in our legal center in the Midlands of England was that there's this takeoff. Whereas before in the 70s, the actual idea was basically you save before you borrow. America changed. But if you looked at the 1960s, in the 1969 Kingdom, 40% of the money was coins and notes. So it's now 3%. So that actually the debt-based money has crowded out what was basically public money over just a couple of generations. And then of course the credit card introduction had a big impact on that particular change. So now we have astronomical charges in this free market with credit cards, as you can see, pawnbroking, secured lending for poor people and those rents, money lenders, which were the kind of typical kind of level about 5 or 10 years ago. That high for low-income people. But with private equity coming into the market, introducing payday loans, the market, as you can see, has actually really, really shot up for these one-month loans up to 5,000%. But even the banks get away with amazing things because the bank overdraft facility under the consumer credit legislation internationally, in most countries, is not actually have to declare an APR. So they don't have to tell you what the cost of borrowing is. So recent exposés by the BBC has shown that the bank overdraft rate can range up to 800,000% if it's not declared. So this problem of usury affects low-income people, middle-income people, and even some better-off people who go overdrawn and should use their credit card rather than using an overdraft. This has caused a huge detriment. The Office of Fair Trading has looked at the scams and the scandals one after the other over the last 20 years. Pensions mis-selling, loss to households of $13.5 billion, lack of competition in the market, $8 billion. Payments, excess overdrafts, $2.6 billion a year, precipice bonds, $2 billion. The latest scams with LIBOR, interest rate swaps for small businesses, another scam. Those haven't been even appraised in terms of the damage in the United Kingdom alone of predatory lending. There are alternatives. In fact, there are basically a whole host of alternatives. Minsky argued for the need to socialize banking. The possibility of socializing banking and how we do it is actually rich in the history if you choose to look at it. We heard about public banking being revived yesterday in Alan Brown's presentation. There are plenty of alternatives, and these 7 alone give you a range of what social banking could look like, because they're all part and parcel, I think, of a socialized banking opportunity. The Singarage and interest-free money experiments, I don't want to talk too much on this because Alan Brown covered it very carefully and very fully, has a rich history in terms of what she talked about Pennsylvania, and of course introduced at periods of warfare. So the First World War, the American Revolution, the Civil War in the United States, interest-free money, printing money has been a common thing. The problem has become when the greenback dollars were withdrawn from circulation, and also when the Bradbury notes were withdrawn after the First World War. But these particular times in history, when people can see that governments can print money willy-nilly, they can freely create money, it sparks people talking about the sorts of things that we're talking about today, because they can see it can be done. And in 1938, as we've heard, in the mid-30s, the work of the New Zealand banks and the Bank of Canada to directly invest in the economy for public housing, for infrastructure, and social programs. One of the reasons why that was done in the late 30s is because Roosevelt's reforms didn't really trigger the bank lending that was expected in the United States. I mean, he had to set up the Small Business Administration, the Commodity Credit Corporation, a whole range of things, but the bank lending. So there's the direct lending in Canada, which actually shows the way that for re-stimulating and socializing the banking way forward. So here's a whole list of interesting organizations. So if we look at the richness of public banking, we look at the trustee savings banks, which were widespread in the United Kingdom. They were privatized in the 80s, so we lost those. Municipal savings banks still exist across Europe. The cooperative banks are a very strong sector. What's important about these public or cooperative banks is that they're local. So if you want to rebuild the money and banking system, you should build on the infrastructure that's already there. It seems to me the opportunity is to take our ideas to the organizations who are lending in the local economy, because they're in a position, they've got the staff, they've got the facilities to make what we're talking about happen. The innovators, so just to give you one example, okay, the KfW Bank, which is was set up by the Marshall Plan, they've been developing through the municipal savings banks in Germany and through the cooperative banks green loans. Those green loans for energy retrofit range from 50,000 euros to 70,000 euros. It's creating 247,000 jobs a year. It's already upgraded over the last number of years, 2.1 million homes in Germany. Historically, there were a whole range of cooperative experiments on housing. For example, in New Zealand, in Ireland, in South Africa, terminating building societies were interest-free building societies for housing, for buying land, for building homes. They existed until the early part of the 20th century when they were banned in the United Kingdom. They carried on existing in New Zealand and South Africa for a number of years into the 20th century, but they were interest-free. People would save in the cooperative and everyone would be guaranteed a house. The Starvoken Societies were another organization that developed in the 1840s in England and Australia. They also saved without interest, and there are lots of them in England and Australia. The mutual banking theory that Shams referred to has been a kind of a prize. It's been a very difficult one to achieve. But as we heard yesterday, the work of Sylvia Gesell with the interest-free money system with a negative rate of interest to increase the velocity of money in the local economy worked in Virgil, it worked in Germany until it was banned. It was introduced in Denmark, Austria, and the USA. Irving Fisher was so impressed with it, and what's interesting with Irving Fisher is that he predicted about 10 days before the Great Depression that the economy was just going to go and go and go. And when it actually collapsed, and after that he gave that interview in the Wall Street Journal, his name became a laughingstock in terms of, even though his work on the quantitative theory of money and net present value and RPI was really cutting edge. But he revisited his assumptions, and he developed a theory which is very similar to what we're talking about. He was very impressed, as Keynes is, with the negative interest fee-based system of Gesell. He argued to Roosevelt that they should introduce, as Shams said, into the United States, 1 trillion of basically quantitative easing in those days with this stamp script money directly given to the people for infrastructure and for creating jobs. Roosevelt didn't take it up. But what he did then in 1935 is he developed the 100% money idea that all money should actually be developed publicly. The public sector should take back the development of money. And by 1939, he had the support of 235 economists from 157 universities, and then the war broke out, and the trail went cold in terms of this particular innovation. What Keynes did, which was different, is that he learned from Gesell, he learned from other people like John Hobson and Veblen, and he decided that actually, if we can't beat them with a negative interest approach, what we can do is try to control the rate of interest through cheap money policies. So his policies were to regulate tightly the banks, to have fixed exchange rates, to stop bank foreign lending with capital controls, to focus on the national economy and real economy needs, to actually cap interest rates on gilts at 0.5% to 2.5%, so that actually the cost of capital would be low for public investment. And if you look at the last point, that during the Keynesian revolution, that period, just finish here. What was interesting is that the gilts, you look at the gilts there, annualized yields over that period versus how they've expanded in the deregulated period since 1977. So, let me just finish by saying there are a number of organizations who are presently doing what I'm talking about. The Jack Bank in Sweden and in Denmark, they're lending an interest-free on a fee-based model for building housing. You know, they've got 40,000 members in Sweden alone. There's a group in the Brazilian co-ops sector in parts of Brazil regionally have redeveloped the Terminated Building Society where they're saving over 10 years, 1,000 people save for a home, and every person gets a home within 10 years interest-free. So these ideas are being redeveloped. We've developed a system in the United Kingdom where we have a very low-interest model for low-income people, which is 3% to 4% for housing retrofit and green retrofit. No bad debts, limited to some of the poorest people in the southwest of England. So these ideas are historically a part of our history that we should recover. Another example is the Fund for Humanity set up in the American South has built 500,000 homes in 90 countries, housed 2.5 million people, and the Fund for Humanity charges no interest whatsoever. People put capital into the fund, and it revolves, and it builds housing in the poorest countries of the world. So there are many, many examples. We've talked about beer. One last thing I just want to slip in, because it hasn't been discussed, and that is the issue of basic income. It's such an important issue, because, for example, what we have seen is the productivity, Henry George said, why progress and why poverty? He said that in 1877. Because basically the issue is around the control of property rights. That's so fundamental. So what this is important about is that people have looked historically in the cooperative movement is that how we could actually make a commons of land, making a commons of banking, making a commons of productive assets, and that could take and capturing the productivity through a change in property rights enables to capture an income. You just need to look at the Alaska Permanent Fund dividend, which is basically yielding $2,000 a year to people. It's a beginning. But what was interesting is, for example, in Sismondi said in 1819, in the first big industrial crash, is that the problem is the lack of aggregate demand. If we want to increase aggregate demand, what Sismondi, the Swiss economist, said is that we should give the workers half of the shares in every company, so that they had two incomes. They had an income from wages, and they had income from the profitability from their own companies. Schumacher said that in Small is Beautiful. If you look at the last chapter of Small is Beautiful, what Schumacher said is that if we want to go small, we have to deal with this issue of lack of aggregate demand. You can fill aggregate demand with borrowing from the future at interest. Or you can fill it simply by actually capturing some of the profits from these companies, by sharing the wealth, and then workers can actually earn an income. Now, Meidner in Sweden experimented with this policy
Can you
in the
draw it to a close
70s,
there?
so that every year 2% of the capital of companies could be put into a fund regionally, and those regional funds could create a basic income. So the issue that was described yesterday of how do we deal with a love economy, we have to deal with a universal basic income. So monetary reform has to connect with Social Security reform. It's absolutely fundamental. That is a wider agenda, but it's critical to the fuller picture of economic democracy. Thank you very much.
Thank you very much, Pat. That is a really important issue you've introduced at the end there, and maybe we can spend some time on that in the Q&A. But we need to move on now to our final presentation from Nick and Joseph, and it is the DECO, which I hope is the right way of saying it, an electricity-backed currency proposal.
DECO is short for delivery of a kilowatt hour, effectively. I mean, it's a mechanism for backing currency. Before I start, I'd just like to say that an electricity-backed currency won't solve a lot of the problems that have been raised here or addressed, and our approach or proposal is fairly simple and narrow in terms of the solution. Get that slide pointer here. Okay. we'll move ahead. First of all, what are we trying to do with the economy? It's how we organize ourselves. And the idea is we want to improve the lot of humanity and ourselves. There's a strong relationship between our ability to utilize and realize energy potential and development. This slide to the right is a simple plot of energy throughput per capita human development. What you see is, as you go to the left, is countries which are not able to harness energy, unfortunately, are lesser developed in terms of human capabilities, human capacity. You can replace GDP with, let's say, a more friendly metric like the Human Development Index, and you get the same correlation. Okay, currently our currencies are backed by debt. And a lot of what we've heard today is we live in extraordinary times. From an economic historical perspective, not really. This shows debt default over the last 200 years. At any point in time, because they're sovereigns. Sovereigns are supposed to be your AAA, AA rated, etc. The yellow lines represent more than 20% of the countries in the world in a state of default or restructuring. This is just a sad reality that politicians like to issue debt and go into default to get reelected. What this says is that currencies backed on debt are not as stable as we'd like. So, a lot of people run back and they go to gold, keeping a hard commodity. Gold is a very stable mechanism in terms of its price stability. So what we've got here is plotted gold versus the monthly prices of electricity. And I want to make a clear articulation between price and value. It's very important to recognize the price might move around. The value of something might stay the same. A kilowatt delivered today effectively is going to be a kilowatt in 10 years. An ounce of gold is going to be an ounce of gold in 10 years. If I have a $1,000 bond that I issue and I collect that principal back, that $1,000 in 10 years, its ability to purchase or buy something is probably going to be degraded due to deflation. So here's our proposal. The DECO is effectively uses existing central banks. Nothing has to change. It uses the existing currency, your existing notes. You don't need to put lightning bolts on them or anything at all. Basically, if you want to work within your current model of a central bank, or you could have a distributed currency, the bank itself purchases something known as a PPA, a power purchase agreement. So they go out to the current producers of electricity, sign up for a 5, 10, 15-year agreement to agree to off-take that electricity, and then they deliver that. And that delivery of electricity into the grid is represented as a ratio of, let's say, the notes. So right now, 1 DECO might equal 10 kilowatt hours delivered. Again, this is the current delivery system. So the PPA sits at that little red circle. Now, how PPAs currently exist and they work is they're used to finance the development of generation. And that could be renewable fuels, it could be anything. Because there's already a certified off-taker, because I know that someone's going to purchase my electricity on a 10-year basis, I can go out and get cheaper financing. And a lot of renewable energy, most renewable energy, is backed using these mechanisms. So here's our primary argument for the DECO. Utility is social or economic utility, or human development, as indicated earlier. Debt has a high degree of utility. It's highly fungible. I can use it to invest in my education, my home, if I need emergency health care, whatever. Gold isn't. Gold's utilitarian function is extremely limited. Pretty much most of the story of gold is we expend energy, primarily poor people, digging gold out of holes in dangerous parts of the world to put it into holes for rich people to look at. And that's pretty much what gold is. You can't eat it. It doesn't have any utility. The last component is the certainty or the value of that claim on a go-forward basis that's backing the currency. Debt defaults, it deflates, it loses its value. That ounce of gold will be worth 1 ounce of gold, whether that's worth to people in the future. Our argument is that electricity has a utilitarian function that is retained in the future. Here's how a central bank works. Just like a regular bank, assets and liabilities. The important thing that I'm talking about is the currency. This is issued currency, and this is what happens. So in this model, we could go to any central bank today, they could engage with PPAs, the power purchase agreement, and start backing their currencies with electricity. Nothing needs to change, no notes, no coins, etc. Simply purchase an asset. This portfolio of assets, which most central banks currently own, could be 100% PPAs if you wanted a 100% electricity-backed currency. Just to give you an example, right now we have a very risky central banking environment globally. 62% of the assets of the central banks of the world are now US dollar based. From a risk management perspective, that's a huge concentration of risk and a huge delegation of power to one country, which probably isn't very safe or practical. Move on. An interesting proposal is that if a bank wished, it could use DECOs, the central bank could purchase this electricity back its currency, and it could advocate renewable sources. There are over 50 countries right now that already get 50% of their power from such renewable sources. Now, these specific countries may not be adequate for a DECO, and the reason is you may have too much of a concentration of, let's say, a single hydro project, or the grid might be too small or unstable. Typically, to go with a DECO, again, right now, you need 4 things. One, you need the good rule of law in the country, so the currency is not debased and these contracts are respected and reflected. The second thing is you need a stable electricity grid, so the premise and promise of delivering value is actually delivered. The third thing that you would require is a central bank that's actually interested in maintaining the value and stability of a currency. And just 1 minute. And the fourth thing that you need is open electricity market that is correctly regulated. So the central bank or the politicians don't abuse the price or value of electricity for their own advantage. Now, another important thing about central banking is if a currency is backed by a commodity, that means the central bank's going to hold a lot of that commodity. And so they can potentially distort, economically distort the value of that commodity. So that limits the central bank's underlying assets to a certain percentage, maybe 10, 20% of the underlying market. Because the last thing you want to do is have a large government or independent actor distorting economic flows of people. So these are the countries that, in theory, could go DECO on a renewable basis, although any country could, with the central bank. Finally, some good news, 2 slides of good news, we'll wrap up. We're getting better at creating human value with energy. Now this is the US, so it's a little bit of an extraordinary case. Many developing countries are getting more efficient at creating value. So effectively what we see here is over the last 30 years, we've gotten about 90% more efficient at producing units of human value as measured by GDP. Unfortunately, I couldn't come up with or find better data using Human Development Index or other aspects. An important message here is that value, or what we consider human value, isn't tied directly to electricity. It's not absolute. All of the economy is belief, it's perception. And finally, this isn't quite the slide I thought I had, but I apologize for that. It doesn't show it here, but actually the fastest growing area of energy build out in the world is actually renewable. I spent a lot of time working and analyzing the costs and learning curves and the production curves of wind and solar, and they're going in the right direction. One of the important things is that as we have more material throughput through a system or an economy, it gets more efficient. Almost all evolutionary systems work this way. More volume, more throughput, greater efficiency through innovation, something called total factor productivity. So the good news is we're getting better at creating value, we're getting better at using our energy, and in theory, any central bank currency today could be electricity backed tomorrow. Thank you.
Right, thank you very much. So we now have a reasonable amount of time for questions, partly due to my brutal handling of some of the speakers. So I hope you've got some good questions. And there's obviously a couple of good questions ready. So what we'll do, obviously that's quite a diverse set of material that we've covered there. So I think it might be useful if you have a question that you'd like to direct to any panelist in particular, if you could say that, and I'll invite other panelists to comment if they'd like to. So the two gentlemen here, please. We'll take both your questions and then we'll go through the panel.
Yeah, I'd like to direct this question at Shane and Pat, and for their comment that interest charged by banks, there's a suggestion that interest is merely a fig leaf to misdirect the public about the creation of money out of thin air. So in other words, the contention is that they're earning money purely on the arbitrage of the loan, hiding, in fact, or obscuring the fact that they're creating the money out of thin air. And I'd maybe invite Sean or Pat to comment on that. And the second thing is, I'd like to refer to the elephant, or the financial elephant sitting in the corner, which is the over-the-counter derivatives debt, which according to the Bank of International Settlements, at the last estimate exceeded in excess of $750 trillion. But in truth, it's not known what that amount is. It varies between 750 and $1.5 quadrillion. Thank you.
Okay, thank you. And can you pass the microphone off to, yeah, thank you.
Actually, Sean has hit on many of the good topics, and actually most of the whole conference has, but I don't know the fellow's name who was talking about keys, but I've been looking at Mrs. work for a few years now, and to get the purpose of the conference, I think, is to help change currency to help all of humanity. Is that correct? Can we answer that real quick? Is that what we're here for, to make a currency that works for all humanity? Can anyone answer that question? Is that the purpose of the conference? Is to change a currency to help humanity?
Well, I mean, I'll try and answer that question. Clearly, we're all here engaged in how the money system can be changed so that it does work for humanity better, whether we think there's a single scheme that will work globally for that, or whether it's a composition of lots of different schemes that work together, is, I guess, part of the subject of this conference.
Can I take that as a yes?
If you like.
Oh, thank you very much. Now, according to Mrs., I may pronounce that wrong, an old economist, he said that every person on the planet has to have access to the currency that is also a commodity that should not be able to be manipulated. I'm taking him out of content, but that is what I get from that economist, and I respect that thing. So what I'm asking you guys is, if we lump this whole conference together into one package to accomplish the purpose of the conference, how do we get from here to there? Thank you.
Okay, thanks for that. That's a very good question. So I'd like all of the panelists to address that second question, but I think the first specifically was addressed to Pat, but you're welcome to comment as well.
I can start. I mean, you have to start with the simple. I think you have to understand how complex systems evolve, right? You have to understand how complex systems evolve. You start with the simple. I think Alan was talking yesterday, you have resilience versus efficiency. Complex systems are not necessarily engineered all at once. They're grown, just like biology, right? So you have to start with something that works in principle, that can be built upon and grown upon. I think, there's a lot of solutions here that are great in theory, but they're too complex to even just have a start. So just think of it as biological evolution. You start with the cell, to the organ system, organism, to ecology. It has to have a similar approach, because what we're proposing here is something that is complex, right? And you're not going to engineer it all at once. So something simple that works, that can be built upon, is an approach. And I agree with, I think it was Margaret yesterday. She was saying we shouldn't agree upon a solution, but maybe we could talk about an approach, a values-based approach, a systems-based approach, to get our hands around working towards a solution. And I agree we shouldn't have a solution here as part of the conference. But that's what I would propose. Simple, evolve, transcend, and include approach.
Can we just stick on that, addressing that second question, how do we get from here to there, and then we'll come back to the first one.
I think the point I was trying to make about there are plenty of alternatives is that there's no one tool. And the system that we're looking at is really a complexity of tools, all linked to a debt-based money foundation. And so Ivan Illich, I think, had it right when he looked in 1973 for a convivial technology. So how do we develop money as a commons, as a convivial technology? Herman Daly had a go at that in 2005. And he gave a speech in New England, and he talked about money as a commons. And what he said was that the problem really relates to the Industrial Revolution, because what happened in the Industrial Revolution is the market was actually artificially created by enclosing the land from people. So people actually lost, in country after country, the possibility to subsist, because they lost the ability to have access to the means of production they could provide for the families in their communities. So that land enclosure, which took place over several centuries with thousands of individual acts of enclosure in the United Kingdom, basically reduced the commons in land to about 3% of the land supply. So that's an issue related to this whole conference, because the issue for me is how do we create money as a commons? How do we create land as a commons? And therefore, how do we create company wealth as a commons? And that will give us a new foundation. That, to me, is the economic democracy message that I was trying to convey. Now, the important thing is to understand in what Daly was saying, and also he was drawing from Carl Polanyi's Great Transformation book in 1944. Polanyi said that basically money, land, and labor are fictitious commodities. That actually they have an intrinsic value that should not be put in the price system. These human beings should be, not priced. They should be. It's life, and life should be, kind of intrinsically valueless. So the issue really is how do we take those things out of the market? How do we take money out of the market, which of course interest-free or negative interest is doing that because it's about a use-free, money as a commons. How do we actually take wage labor out of the market? Well, that's around economic empowerment and ownership of productive assets and around cooperative economic democracy. And therefore the Meidner Plan was moving in that direction. And thirdly, how do we take land out of the market? Well, I've been working for the last 12 years in the United Kingdom on community land trusts and what they do. If you look at what Ellen Brown was saying, if you move to public banking, you can actually produce finance at a fraction of the cost because, of course, you're only working on fees, not interest. If you look at housing, in most countries, OECD countries, the house is actually two parts. The part of the land and the part of the building of the house. If you take land out of the market, you can build housing at half price. And you can actually bring a lot of the asset inflation down. So land reform, corporate reform, and money reform are all part of, I think, what we need to do to get there.
It's a political question of how we initiate transformation, and this conference could be a stepping stone to do that, and it's follow-up conferences, and I don't believe it's complex. I believe what you've got to show the 99%, it's very simple. The technology is disruptive, it gives you the power to create competing and alternative and substitute currencies. Power for the people. People can create credit, they can create money, and they create money long as they get insurance, and insurance fee creates demurrage money, and the question of interest is solved. The insurance fee is the risk margin of creating credit, and you democratize that process at the local level. And I don't see it complex and simple. You start from the bottom up. It's reforming and rebuilding the financial system from the people up. and you get the political constituency from the 99% and the politicians and the bureaucrats will be forced to follow.
Agreed.
Thanks for that. Now, we mustn't forget the question about the OTC derivatives and other sources of instability. And your question was also about interest, wasn't it?
Yeah, it was just that the suggestion that interest charged on bank loans is a classic misdirection, because most plain people don't realize, perhaps what many people here in the room realize, that bank practices are totally apart. Most people think that banks make their money through arbitrage. They borrow the money from one source and lend it out in another, and that they make their money on the arbitrage, on the interest difference. And I contend that this is just a means of misdirecting the general public, to confuse them that the money they lend is created out of thin air in the first place.
Thanks. Well, do the panelists share that view?
Yes, and I've already answered that question. You just don't allow banks to create what I call negative money. It creates the positive liability. You have positive money, which the people create. We don't want banks or governments creating money. We want people who create wealth creating money, the producers, the traders and the investors. And the demurrage fee is a fee for the insurance. So we don't want to go there. We don't want to explain, don't want to get into the technicalities and complexities of the banking system. We simply say, here's a simple competitive alternative which is popular, democratic, and vote for this.
What I would add to that question is that I think if you look at the international cooperative movements, I mean, in the United Kingdom alone, we're talking about 3 million people. In every country, it's a significant portion of the population. But in the early part of the 19th century, the terminating building societies, the star bucket societies, all those experiments were trying to find a way to create a money system without interest. Robert Owen, founder of the cooperative movement, really believed that it was possible to have a fee-based money, and he developed the labor notes. Josiah Warren developed the time stores in the Midwest of the United States. Those experiments were not able to use labor as a source of value effectively. That was the issue, but they were on to the right track. That's the point. And it was Gazelle's innovation in the 30s, but he started writing in the 1890s in Argentina about this, which was saying, going back to those cooperative pioneers and saying, how do we build the better mousetrap? How do we find a way to create a fee-based system? What happened is the credit unions, the building societies, the mutual banks, all converted over to a banking model. And that made them very exclusive rather than inclusive. So it's really, there are tens of thousands of credit unions, there's a lot of mutually owned institutions. They're in a fantastic position to go the right road. They're going the wrong road. But they need to develop this fee-based system of lending, replacing interest with basically use fees. And really, whether you're talking about, it's cheap money, isn't it? I mean, what Keynes was trying to do to get it down to 2.5%, there weren't any crises. There was no major financial crisis between 1940 and 1977. That period didn't have the instability that Minsky showed happened once you actually let the market rip.
First of all, I'd like to clarify, there's been a lot of discussions about interest and Demirag. You need to realize that when you hear an interest rate, it's a relative term relative to inflation. And I would advocate to be very careful what you ask for, because right now we're seeing incredible contraction in economic activity in China and other countries. What that's going to lead to in terms of deflation will be negative real interest rates. What that means is that the debts that you currently hold as consumers